Okay, folks, it is time. We're going to get started. A couple of things before I start. One is I don't think we have class next Monday, right? Is that right? You have a long weekend coming up?
Yes.
I think you're off next Monday. So our next class will not be until Wednesday. I got very stern letters from the dean and from Andy Hamilton and from everybody saying that this is supposed to be a quiet weekend. I have no idea what that means, but I'm supposed to leave you with nothing to do.
Professor,
I'm actually not going to email
broadband
you,
is
but,
glitching again.
No, there are only 2 more weekends left after this weekend before school kind of wraps up. So I don't even know what the university was thinking when they thought about having a quiet weekend, 2 weekends before school ends. I don't see how it can be quiet if you have things to catch up on. But maybe you're all caught up and you can take the weekend off. But I won't bug you, but you might have to bug yourself if you're way behind in the project, class, whatever. Are there any questions before we start?
Professor, your audio is really choppy and the video screen is blacked out as
So
well.
what I'm going to do today is actually talk about
I guess you can't also hear me.
Up till now, every company we valued is a publicly traded company. So if my my broadband's been going in and out, so if it gives you issues, let me know so I can turn off my video because it seems to improve the audio somewhat. So my slides are not going through, just let me know. So everything seems to be now I can move my hand and I can see my hand show up like 30 seconds later, which means there's a huge lag between what I'm saying and what you might be hearing. But it's an issue, let me know. So today we're going to talk about valuing private companies. And I'm going to start with a very simple test again about what makes private companies different from public companies. So let me start with the test. And I'm going to start with a very simple question. And I'm sorry, this is the wrong one. Let me pull up the wrong. Sorry about that. No, I am going to turn off my video. I can see it's creating an issue already. Okay. So maybe that'll help. So let me start by pulling up, I pulled up the wrong test. So let me pull up the right one. Parth, what's
Professor, are you seeing a delay now?
I can't hear you. Hang on. Okay, try now. Maybe
Hello? Professor?
Still not working. Hang on. Let's see if it's just you or everybody else. Brian, say something. Let's see if I can hear you.
Can you hear me? No?
Okay, so I can't hear a person. You can't see me. Can you hear me at least? Okay. Worst comes to worst, you might just hear this disembodied voice coming at you. So I might have to use sign language. Let me pull up the chat. Maybe I can see what's going on in there. Okay, so chat, I can see ha 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 ho ho. So this is the reason I don't read the chat. Lots of stuff going on that I don't want to read. But if you have any issues, you might have to let me know in the chat, because I know, as I said, I can't really even tell. Raja, what do you want to say in the chat? Well, because obviously I can't hear you right now, so no. No? Okay. If you want to send in the chat what your issue is. I can't hear any of you. I'll tell you up front, I can't hear any of you. I can see all of you. I can't hear any of you. Hopefully you, as long as you can hear me, I can deliver the lecture. But we'll see if it gets better over the course of the next 30 minutes or so. Maybe the broadband will get better and I can connect. So as I said, today we're going to talk about valuing private companies. And if you think about why that's an issue, now every company we valued so far in the class has been a public company, a publicly traded company. And we don't even realize how much of an advantage we get with public companies until we actually value a private company. So let me start with a very simple question. And obviously, since I can't hear you, it's going to be difficult for you to actually tell me the answer, but think through the answer yourself. Let's assume that, shoot, it's not the one that I wanted to, excuse me while I put this on. Let's assume I'm looking at two companies. They look exactly the same in terms of financials, in terms of size. But here's where they're different. One is a publicly traded company. The other is a privately owned business. They're in the same business, same size, same issues. Which of these two companies will have the higher cost of equity, if either, right? Same business, one is privately owned, other is publicly traded. Which one would you expect to have the higher cost of equity? The privately owned business, the public company, or should they both have the same cost of equity? It's the same equation, right? Risk-free rate plus weighted times risk premium. So think about it. And then I'm going to ask for a show of hands. How many of you think the privately owned business should have the higher cost of equity? Okay, I see a lot of hands going up. Okay. How many think the publicly traded company should have the higher cost of equity? I see a lot of hands going down. I see a couple of. So it looks like the overwhelming majority of you think the private company should have the higher cost of equity. And it turns out you're right. The private company will have the higher cost of equity. And one of the things we're going to talk about today is why. What is it about the private company owner that makes the company riskier? It turns out to be something very simple. If you're the investor in a publicly traded company, you have the option to be diversified. You have the option. You might choose not to take it, but you have the option to be diversified. If you own a private business, often you cannot be diversified, not because you don't want to, but because you don't have enough money. You're going to see that that makes a huge difference in how you think about risk. A diversified investor can be a lot more casual about the way they think about risk than a public company. And that's going to come into play with the cost of equity. Follow-up question. We've never used the word illiquidity so far in this class. You know what I mean by that? You value a publicly traded company, you come up with a value of $30, the stock price is 25, we say the stock is undervalued. But we can stop and ask, what's the float? How liquid is this company? You know why with public companies, we don't worry about illiquidity? Because it's already in your decision process, and here's why. Let's say you look at the price of 25 and the value of 30, the stock looks undervalued, you go to buy the stock. Even though the market price is 25, that's what you see in the journal or CNBC. You know what? Stocks don't trade at a price, they trade at a spread. It's called the bid-ask spread. The bid-ask spread basically reflects the fact that if you try to buy a stock, you pay a higher price than if you try to sell the stock at exactly the same time. That spread can be tiny for some companies, huge for others, but it's already in there. So when I try to go buy the stock with what I thought was a $25 price, if it's a very illiquid stock, the spread might be 22 to 28. In other words, when I buy it, I have to pay 28, and there goes my undervaluation. So with public companies, the process of trading takes care of illiquidity. But one of the things we're going to talk about with private businesses is when you buy a private business and you change your mind, the cost of buyer's remorse is far greater. You know what I mean by buyer's remorse? What's the big story today? What company went IPO today? Coinbase, right? $100 billion market cap. Let's say that you've had too much caffeine to drink, and in a moment of caffeine high, you take a third of your portfolio and you buy Coinbase. This happens at 10:30 in the morning. At 2:30, you come back to earth and you say, what the heck have I done? I put a third of my money into this company that makes its money entirely of crypto trades. And you sell the stock. The cost of buyer's remorse with a public company tends to be fairly small because the price hasn't moved much. All you're going to have to deal with is the spread. But if you bought a private business, let's say you bought the corner grocery store you walk into every morning, moment of weakness, you take half your portfolio and you buy the corner grocery store. Changing your mind becomes much more consequential, right? It's not easy to get out of that transaction. So with private companies, it becomes more critical that you think through what it'll cost you if you change your mind. You're doing it preemptively. While you're buying the stock, you're asking, what if I am wrong? What if I have to sell the stock? And you got to bring it in through what's called an illiquidity discount. And that discount can vary across time, depending on what the market is doing. In the middle of a crisis, that discount can be huge, but in good times, the discount can be much smaller. So we're going to talk about how to deal with the fact that investors are not diversified. We're also going to have to deal with the fact that illiquidity is a clear and present danger that somehow has to be incorporated explicitly. Final question. You own a private business, and you're looking for potential buyers. And I'm going to give you 3 potential buyers. The first is a private owner, another individual. The second is a private equity fund that's interested in buying your business. The third is a publicly traded company. So you own the private business and you're looking at these buyers. Which of these is your best potential buyer? Which is, I think my AirPods are working now. So if you want to, so you own a private business. Raja, you're building a private business. You have 3 potential buyers. One is a private owner. The second is a private equity fund. The third is a public company. Which one of these 3 is likely to pay you the highest price, be the best potential buyer?
Oh, can you hear me?
Yeah, I can hear you now.
Oh, okay. I typed in the chat, but I'm thinking a publicly traded company.
And tell me why.
I think you'd get the best price as well as the best kind of leverage potentially with equity ownership.
Okay, let's ask the question. What is it about the public equity company that allows it to pay the higher price?
I guess more cash on hand as well as more.
One is cash on it, but think, you want to add, what is it about the public company that allows it to pay a higher price?
Are they willing to pay more due to potential synergies?
That could be, but potential synergies can occur anywhere. But it could also be because when you look at risk as a public company, you can be a much more casual about risk. And here's why. Your investors are diversified. You make a mistake, it's not the end of the world for them, right? So you can afford to look at risk and say, the only risk I care about is the risk I cannot diversify away. If you're a private individual, even if you've done all your homework, if you screw up, your entire wealth rides on this mistake. Again, a point we made about different costs of equity. So today we're going to actually make that explicit with a private company, why it is that private companies are often worth more to a public buyer than to a private individual. So let's build on this explicitly. I'm going to go back to election notes now. And we're on page whatever, 123. And we're going to talk about private company valuation. It's kind of the wrap up to intrinsic valuation. So let's start with the process of valuing a private business. Let's face it, most of you know people who own private businesses. Your families might own private businesses. You're going to make yourself incredibly useful to your family if you can do this. So let's think about the process of valuing private companies. You know how we value private companies? By taking the expected cash flows and discounting back at a risk-adjusted discount rate. You say, but that's the way we value public companies. The principles remain the same. It's still about expected cash flows and risk-adjusted discount rates, but the way we adjust for risk might be different for private companies. The way we get the cash flows might require more work. And as with a public company, your starting point has to be, do I want to value the entire business? Or do I want to value just the equity in the business? It's the same question we started the public company valuation. So there are two things you're going to run into with private companies that'll make them more challenging than publicly traded companies. The first is there's no market price. You're saying, so what? Those of you who valued public companies didn't even probably realize how much it helped to have a market price for your company. The absence of a market price is noticed only when it's not there. We're going to talk about what happens when you don't have a market price. The second problem you're going to run into is the financial statements for a private company might have a set of accounting standards you've never even seen before, forget about heard of before. So let's take each of those issues. Let's start with the issue of market value. Rodrigo, I figure you valued an iron ore mining company, right?
Yes, a steel and iron ore miner in Brazil.
And it's publicly traded. So let's think about all the places where market value came in. First, when you did cost of capital, the weights for equity and debt came from market value. Market cap used it, right? So you came up with the cost of capital. After you finished your valuation, you got a value per share. What's the first thing you compare it to? That's true for all of your valued public companies. What's the first thing you check to make sure you've not completely gone off the tracks? You compare it to market price. You don't realize how nice it is to have that comparison. Raja valued a private company. And when he was done, if he looked at the number and said, what does it tell me? You really have nothing to compare it to. You could be off by 3 zeros and not even know you're off because you don't have that comparison. So prices play as inputs, prices play as outputs. And the way we get risk measures for many companies requires past prices, right? If you run a regression beta, you run past prices. With a private company, there's no market cap. We have to confront what to do in the absence of a market price. That's the first problem. The second is the way we estimate cash flows for a private company is exactly the same as the way we estimate cash flows for public companies. After-tax earnings, net capex, change in working capital. But here's the challenge you're going to face. The first is, and this is not always the case, private companies tend to have shorter histories than public companies. While there are some private companies that are out there that have been around for 150 years, most private companies haven't been around that long. Second, if you're complaining about differences in accounting standards for public companies, you should see the accounting standards at some private companies. I still remember about a decade ago, somebody in this class decided to value her mother's flower shop. A mom owned a flower shop, and she came to me and said, hey, can I value my mom's flower shop? And I said, sure, go ahead. And 4 weeks later, she came back into my office and said, no, I have to change companies. I said, what happened? Do you have a fallout with your mom? She said, I went and visited my mom and asked me for the financials. And she led me into a small room where the walls were covered with Post-it notes. And I said, so? And she said on one wall, she had yellow Post-it notes and she called it a revenue wall. And the other wall, she had green Post-it notes that she called a cost wall. And she said at the end of every year, she pulled the Post-it notes down and did the accounting. And can you blame her? I mean, she has a flower shop to run. She's got to be in the front. To her, accounting is an afterthought. Now, I've heard of IFRS, I've heard of GAAP. I've never heard of Post-it note accounting, but with small private businesses that can happen. The third is in private businesses, and it can happen in some small public companies as well, there is this line between the personal and the business that gets crossed all the time. You know what I mean by that? The business owns a van, a minivan, supposedly for the purpose of the business, but every afternoon at 3 o'clock on weekdays, the van magically disappears. It's around the time the owner's kids get out of school. The van is out there picking them up. It's clearly not part of the business, but you can see this, this is, or the owner claims to have an office in his home for the business, but the office is cluttered with, cribs and toys and dog food and whatever else. The line between the personal and the business gets crossed all the time. And finally, this is something even with well-run private businesses, you got to be careful about. In many well-run private businesses, the owner will not charge themselves a salary. So let's say you're looking at the financials of a pizzeria, and the owner of the pizzeria is the one behind the counter. He makes the pizzas, he sells the pizzas. You look at the financials, and you notice that this owner is not charging himself or herself a salary. You can see why, right? You own the business, you're going to get whatever's left over. Why would you waste your time charging yourself a salary? You're going to get it anyway. But you see why this is going to be an issue if you're valuing the company to buy the business. If you're going to buy this pizzeria and you buy it based on the stated financials, you're going to pay way too much. Why? Because the owner has not built in the cost of the 18 hours a day he spends at the pizzeria, making the pizzas, cleaning up the place, being the cashier, the accountant, the inventory keeper. Something you don't think about with public companies, but you have to with private businesses. So here's what I'm going to do. I'm going to start by looking at why we value private companies, something we never did with public companies. I'm going to argue that the motive matters. Why somebody wants you to put a number on their business can affect what value that they actually see. And I'll tell you a story. About 20 years ago, owner of a candy company in New York, privately owned, came into my office and said, I'd like you to value my company. And I said, I don't do valuations for hire. And she gave me a big candy jar. And I said, okay, I can do valuation for a big jar of candy. And I asked her, why do you want to value for your company? And she said, what do you mean? And I said, are you just curious? Some private business owners want a number for their business because they're curious about how much it's worth. She said, no. I said, is it for divorce court? Because if you live in a community property state like New York or California, the minute you get divorced, half of everything goes to your spouse, which means you got to value your candy business for your soon-to-be ex-spouse. And she said, no, that's not it. I said, then why? She said, I want to sell my candy business. And I said, to whom? She said, you have a lot of questions. I said, to attach a value to your company, I need to answer these questions. And she said, what do you mean to whom? I said, are you planning to sell it to another private individual? Are you planning to sell it to a publicly traded candy company? Are you planning to invite, get a partner to buy you up? One of the things you have to remember, especially when you value private businesses, you need to figure out why you're attaching a value to the company, because that motive can actually affect the number you come up with. Something we never thought about with public companies, but something that becomes part of the process with private companies. And it's not just privately owned businesses. If you're trying to value the division of a publicly traded company that's for sale, you've got to go through many of the same issues that you do with private companies. So here's what I'm going to lay out. I'm going to actually look at 4 different sets of transactions involving private companies. I'm going to start with the most complicated, private individual to private individual, transaction between 2 private individuals. Then I'm going to talk about private company being sold to a public company, easiest of all scenarios. Third, I'm going to look at private company getting ready for an IPO, right, where you go public as a, And finally, I'm going to talk about a private company that's inviting a venture capitalist or private equity investor to become part of the ownership so they can sell to the public eventually. So let's start with private to private transactions. And here are the characteristics that make it really messy. So you know what I mean by private to private? I'll give you a classic example. You're a doctor. You built up this great practice, but you're 60 years old, you want to retire. You want to sell your practice. Who do you sell it to? A young doctor wants to start the practice. Your private to private transaction. First problem you're going to run into is neither side of this transaction is going to be diversified. Neither the seller nor the buyer is going to be diversified. It's almost a given. I mean, what doctor has enough wealth to have the practice and have $10 million in a portfolio? So neither the buyer nor the seller is diversified. Second, almost by definition, the investment is illiquid. If you buy that practice, it's not going to be easy to sell it quickly. And thirdly, and this is something that we've never talked about in the context of public companies, especially in private businesses that involve a personal component. The value of the business can change if that person leaves. But take the doctor's practice, right? You're a great doctor, you built up a practice, and I look at your financials and you made $1 million last year. You know why I have to be careful about paying for your practice based on last year's financials? Why do you make $1 million? Because you're the best known doctor in town. Everybody comes to you, they love you. If I buy your practice and tomorrow I put myself in your chair and I'm now the new doctor, what makes you think that all those clients are going to keep coming? They're not coming to a nameplate or a company. They're coming because they know a person. It's called a key person discount. And with private businesses, it can actually knock off 25 or 30% of your value if you're the person that people think this business revolves around. So I'm going to use a very simple example to do this private to private transaction. I'm going to value a restaurant. The restaurant is for sale by its owner, who happens to be a well-known French chef. It's an upscale French restaurant. The owner is also the chef. And he has 3 years of financials he's going to give you. The restaurant's been around 3 years. It's doing really well. The potential buyer is an ex-investment banker. He's tired of investment banking, the 16-hour days, the 7 days a week. So he's cashed out. He's got a nice paycheck that he's got. And he's planning, he's always wanted to own a restaurant. And he's planning to buy this restaurant. So you can see the setup, right? On the one side, you have the owner chef, and the other side, you got an investment banker. Neither side is diversified. And you have 3 years of financials. In the most recent year, the restaurant generated about $400,000 in operating income on a $1.2 million revenue. So it's a profitable, well-run restaurant by a chef who's also well-known. The restaurant operates in a lease space where it has 12 years of lease left in the lease agreement, and they have to pay $120,000 a year for the next 12 years. So your job is to value this restaurant. I'm going to approach this in 6 steps. Before I start on the steps, I'm going to show you what the past financials look like, and I'm going to add some notes to each item that might or might not affect how you value the restaurant. There are my revenues on top, and by the most recent year, I'm operating at full capacity. You know what I mean by full capacity? I have 20 tables in my restaurant. There are 4 chairs apiece. I can't keep increasing the number of people who come in because there's no place to sit. Now, you might have other ideas. You might want to run an online ordering system on the side, but that's yours. This restaurant right now, just the restaurant, already full capacity. It's got $120,000 in lease expenses every year. I told you about this, 12 years left. It's got $200,000 in wages. This is, the help, the waiters, But I have to tell you that the chef does not charge himself a salary. Why? Because he owns the restaurant. He's going to get whatever's left over. Now, keep that in mind. You're an investment banker. You haven't cooked a lick. You buy this restaurant tomorrow, unless you plan to become a French chef overnight, you better hire somebody, but that's not built in here because it's not including the cost. Net of everything, the operating income is $400,000, the net income is $240,000. So it's 3 financials, pretty professionally done, but the absence of a salary is an issue because that salary expense is something you got to factor in. So here's the first step. I'm going to try to estimate a discount rate to use to discount the cash flows on this restaurant. Now, it's true, conventional risk and return models, you run a beta, you run a regression, you take the regression beta. If I were dependent upon that, I'm already sunk, right? Because if I try running a regression beta on this restaurant, what am I going to find? Nothing. There's no publicly traded company, there's no stock price. And we also have to deal with the fact that even if you can run that regression and get a beta, the beta measures only the portion of the risk you cannot diversify away. In every public company valuation we've done so far, we've made the assumption that investors are diversified. And because they're diversified, they care only about the portion of the risk you cannot diversify. And that's what the beta measures. And I already told you that that's not the case here. Neither the buyer nor the seller is diversified. So let's start thinking through what to do because you have an undiversified buyer. I'm going to start doing what I do with any company, right? With even the publicly traded companies, the way we got betas is by doing a bottom-up beta. In this case, I started by looking at the beta for publicly traded restaurants. Hang in there for a moment. I know it's not publicly traded, but I looked at publicly traded restaurants. And I ran into a bit of a problem. If you list off all the publicly traded restaurants in the US, you know what you're going to see on the list, right? You're going to see McDonald's and Burger King, And this is an upscale French restaurant. I know already that that beta is not going to miss it. That's a beta for fast food restaurants. And I'm looking at an upscale French restaurant. Do you know what I ended up using as my beta? I used the beta for high-end retailers. Because my argument is the people who shop at Gucci and Tiffany's are more likely to come into a French upscale restaurant than the people who hang out at McDonald's. The unlevered beta for these high-end retailers is 1.18. So if this were a publicly traded restaurant, I'm home free. That's my unlevered beta. But I already told you, there's a private business being sold to an individual who's not diversified. I know I keep emphasizing the word not diversified. Who cares? Let me do a very simple abstract example, and you will see very quickly why not being diversified is going to create all kinds of issues for you. Let's suppose you have a company with 100 units of risk. It comes from all kinds of different places. 20 units are market risk, macroeconomic, market-driven. 80 units are company-specific. When you value this company as a publicly traded company, you focus only on the market risk. That's what a beta measures. You ignore the other 80 units. Why? Because in your portfolio, those get averaged out. So you're saying, I don't care because I'm a diversified investor. Now, in this particular case, the buyer is not going to be diversified. When they look at this company, you know what they're going to see? Not just the 20 units of risk, but all 100, because they're saying, look, I'm exposed to all the risk in the company because I've got all my money in the company. So intuitively, you can see why looking at the same business as an undiversified investor, you see a lot more risk. And if you see a lot more risk, you're going to demand a higher cost of equity. That intuition has always been there. But the way people put into practice is really troubling. I remember about 30 years ago, I was asked to give the keynote at a conference of private company appraisers. There are like 500 or 1,000 of them. I think it was New Orleans. So I walk in, and at that time, I'd never valued a single private business from scratch. So I threw out this question to the private company appraisers who dealt with only private business. I said, look, I know that every risk and return model we have in finance is designed for publicly traded companies. Risk-free rate plus beta times equity risk premium is a cost of equity for a public company. And I said, I know that you guys value small private businesses where the owners are not diversified. They are exposed to more risk than you see in that beta. I said, what do you do to bring in that additional risk? They looked at each other and then looked at me and they said, we add 10% and we call it a company-specific risk premium. And I said, why 10%? And they looked at each other again because that's what we've always done. There was no good reason. I can see the intuition that they were going with, I need a higher cost of equity, but to call it a company-specific risk premium and attach an arbitrary number is not the way to do it. They said, but what else can we do? We can't look at the cost of equity for other private companies. There is no beta for private companies we can look at. So after I finished that keynote, I started working on a process of estimating betas for private companies. And you tell me what you think about this. It's a pure algebra setup. I said, you know what? I can get the market beta for publicly traded companies by looking at publicly traded companies. But that market beta measures only the portion of the risk that I cannot diversify away. What if I could figure out how much of the risk in a restaurant or a retail company comes from the market? Now, whether you remember those Bloomberg pages we looked at for the betas, in addition to reporting a raw beta and adjusted beta, those Bloomberg pages also had an R squared, right? Basically telling you what proportion of the variance in a stock is explained by the market. I went and looked at every publicly traded retail firm, and I looked up the R squared, and the average R squared across high-end retailers was 25%. So this is the R squared for publicly traded companies. What does it tell me? 25% of the variance in a typical retail firm is explained by the market. Now, this is a little inside statistics component, but beta is a standard deviation measure. It's not a variance measure. So if you take the square root of the R squared, you get what's called the correlation. Square root of 25% is 50%, 0.25, 0.5. Half of the variation in a typical retail company comes from the market, half of it is company specific. Let's set up an algebra problem. If you're a diversified investor and you're focused just on the portion of the risk that you cannot diversify away, you're going to use a beta of 1.18. But if you're not diversified, you're exposed to all of the risk, you're not going to see a beta 1.18, you're going to see a beta of 2.36. You're exposed to total risk. I call this a total beta. I concocted it in the early 90s. I called it a total beta. And my intuition was the total beta captures the total risk in a company, not just the risk that is market risk that we capture in a traditional market beta. So I'll tell you a couple of things about the total beta. It'll always be higher than your market beta. Why? Because you're adding in the extra risk, which will mean that for a person who's not diversified, the beta you're going to get is going to be much higher, which then will give you a higher cost of equity. I'm going to pause there at least to make sure that the intuition sinks in. So basically, I'm doing what I did with public companies, getting an unlevered beta, but I'm adding a layer to that and saying, hey, how much of the risk in a typical retailer restaurant comes from the market? Let me adjust the beta for that extra risk. Any questions on that? Now, once I get an unlevered beta for a company, it's a publicly traded company. Remember my last step, I brought in the debt to equity ratio of that company. But the debt to equity ratio I brought in was a market debt to equity ratio. And with a private company, I ran into a bit of a brick wall. There's no market debt, there's no market equity. I can't use a book value, it's completely meaningless. So here's what I did, and I'll come back and revisit this assumption. To get started, I said, look, I can't get a market debt to equity for my company, but I can tell you what it is for a typical public company. Typical public company, the debt to equity ratio is about 14.33%. I'm going to assume that that's the risk reflecting the business you're in. And your levered beta then will be the unlevered beta that you saw on the previous page, the 2.36. Levered up at the debt to equity ratio, giving you a beta of 2.56. So the investment banker looking at this company will see a beta of 2.56 and a cost of equity of 14.5%. A little more work than a typical public company, but that additional layer of pushing up your beta to reflect the fact that there's a lot of firm-specific risk and the person is not diversified gives you a much higher cost of equity. Now the cost of debt, I followed a more conventional route. Tim, go ahead.
Yeah, but then isn't that assuming a capital structure? That's like a target capital structure. Isn't that kind of?
It's a problem. I agree. The thing is, at this point, I don't have an alternative, right? Because the typical public company, we can say, should it be the industry average? So we use the current debt to equity, which is the market debt to equity now. I don't have a current numbers.
So is that capital structure from like the public comps and then kind of
exactly.
Like okay.
Yeah, exactly. But I'm going to come back and check to see whether this is an unreasonable assumption. But that will require me doing through the whole process. Then I'm going to use this neat little trick to try to fix an issue if there is an issue with this debt to equity ratio. Let's talk about the cost of debt. Remember how we computed the cost of debt for a company without a rating? We computed a synthetic rating based on the interest coverage ratio. Hey, you know what? I can do that for a private company. An interest coverage ratio requires operating income and interest expense, which I'd be able to get for any company. The interest coverage ratio I got for in this case for this restaurant was 3.33. I went to the lookup table for small companies. The rating I get is BB+. That rating gives me a default spread of 3.25%. This is exactly the process I followed for public companies, but I'm now applying it to a private company and getting a cost of debt after taxes of 4.5%. So my equity costs 14.5%, my debt costs 4.5%. I'm still sticking with the industry average, 14.33% debt to equity ratio, and coming up with a cost of capital of 13.25%. So I've overcome the barrier of not having a market cap by using the industry average. I've overcome the barrier of not being diversified by using a total beta. And I've ended up with a cost of capital now that is much higher for this company than it would be for an otherwise similar public company. Nick.
Yeah, so Professor, in this calculation, you only use operating leases. For example, if the owner uses his own, like it's a So proprietorship, and he borrowed money from the bank.
You'd have to add the debt because, in fact, in the description of the restaurant, I said the only debt they had was the lease commitments. But if they had additional debt, I would take the interest expenses on that debt and use it to do the interest coverage ratio.
I see. Thank you, Professor.
Rodrigo?
Yeah, Professor, would it work to base the equity value on a pricing?
You could do it on a pricing. Yeah, so you could apply a multiple, but you'd still have the same issue. Where are you going to get the pricing?
Well, you have the financials for the business and attach like
I'll give you the earnings, but you have to use a price earnings ratio, right? If I give you
Yeah.
EBITDA, you got to use where are you going to get that multiple? By looking at
the market, the comparables.
publicly traded companies.
Yeah.
Right? You're facing it no matter what you do, you have this issue with all your data comes from public companies, and here you're looking at a private company.
Yeah,
We
but
don't know that. Yeah. Go ahead.
Isn't it a safer assumption to make on the pricing rather on the capital structure?
It's a different assumption. Sometimes it'll give you more reasonable numbers. Sometimes it's going to give you less reasonable numbers. Right? So it's just a different assumption. They're both based on the fact that I'm still using on public companies. You're just using a different metric, PE ratios, and I'm using debt to equity ratios. Ex ante, if you ask me which one is they're both in a sense unreliable here. I'm starting with an unreliable number, but I have no choice. They're all unreliable choices. So I've got a cost of capital. Any other questions about the cost of capital? Nick, you have another question, or is your hand up from before?
Yeah, I do. My question is, like I briefly learned in a fintech class about this thing called public market equivalent. Does it have anything to do with what we're learning right now?
I have no idea what that even means. So if you can give me the description, maybe I can relate it, but I don't think so. A public market equivalent is usually a pricing. So maybe it's got to do with pricing, where you look at, hey, what did a public market? So it goes back to what what Rodrigo mentioned, which is, hey, rather than try to estimate the value of equity, I'm going to take the PE ratio of other companies in the sector, apply it to my company's net income, and end up with the equivalent of a market cap. So maybe that's what they mean. But unless I look at the description, I couldn't respond more specifically to that.
Yeah, I understood exactly what you described, Professor. Thank you.
So now comes the second step. I took the financials, and for the most part, it was well done. I've seen private company valuation where the financials are so completely mangled. I still remember I was at an Asian family friend asked me to value their private business. And I went in and they showed me the financials, and they were horrifically bad. This company had never made money in its lifetime. And I said, how come you're running this business? We are losing money. He said, these are our official books. And already my stomach dropped because, what he was showing me was the books he showed the tax guy. And if you show losses, you pay no taxes. And he said, can I show you something? Then he led me into this interior bunker room with no windows and no obvious places you could monitor. And he said, just between you and I, let me show you a different set of books. And he pulled this ledger out from the bottom drawer from a hidden compartment. He said, no, this is what we actually make. Valuing companies like those is a nightmare. If this guy lies to the tax guy, how do you know he's not lying to you? But what I'm trying to say is what you see as the books might not be the official recording for a company, especially if it's a private company. In this case, the books were pretty good. The revenues actually reflected what they actually made. The two adjustments I made, one is the lease expense I removed from the operating expenses for the same reason I've done it for a public company. Remember, it's a financial expense. And I also put in $150,000 to hire a chef. You see why I need to do this? If I'm the banker buying this restaurant, I better set aside money to hire a chef. Otherwise, who's going to be cooking tomorrow? So that $150,000 does reduce their operating income a little. I do have an implicit interest expense now from the leases being capitalized to debt. But clearly, I've shifted the numbers. They're less attractive now after my adjustments than they were before the adjustments. But that's primarily because I'm bringing in this $150,000 salary. So I've got my step two. Now I have to stop and ask, if I buy this restaurant, will the people who kept coming to my restaurant until yesterday continue to come? Remember, I said this restaurant is run by a chef who's well known. And especially with upscale restaurants, people often come not for the name of the restaurant, but because the chef behind the restaurant is a well-known chef. See, what I'm worried about is I could pay all this money for this restaurant based on last year's income statement. Then I could run the restaurant, and tomorrow when I would open the restaurant, there are far fewer people coming in because they've heard the chef is gone. It's called the key person discount. Now I'll tell you a story to illustrate how significant this discount can be. I have, we have 4 kids, and all 4 were braces. And if you've ever had braces, this becomes this cash cow to the dentist who supply the braces, because it's almost like every month you got to go in, they tighten it, I think they do it just to keep you coming back. They tighten it too much, so the next month you complain to your parents, they have to take you back again. So we used the same dentist for all 4 of our kids. So when we first started going to this dentist, I think he was in his mid-30s with my oldest son. By the time we got to my youngest son, he was in his 52 or 53. And I knew him as well as I knew pretty much everybody, as well as I knew most of my family. So I was taking my youngest son in for his braces, and dentist, his name is Howie, said, can you come into my office? I have a couple of questions to ask you. So I went in, and he said, I'm thinking of retiring. And I said, you're like 52. Why would you retire now? He said, you know what? I've made a lot of money. And I said, well, how do you make all this money? And he said, take a look at the bills you've been paying for the last 18 years and multiply by the number of kids in this town. You're going to see why I made a lot of money. And he showed me the books, and he had made like $1 million the previous year. And he said, no, I'm planning to sell the business. Do you think I will get good price based on this income? And I said, you're probably going to be disappointed. I said, I know the person buying this practice is going to pay nothing close to what you think it's worth based on $1 million. And he said, why? I said, think through this. I'm a young dentist. I come by your practice. I put myself in the dentist's office. Next morning, the doors open, and I walk in with my kids. You know what I'm going to ask you? Who the hell are you? So I'm your new dentist. I said, no, you're not. I've never seen you before. I get out, I walk out of the door. Do you see what can happen? You buy this practice based on the income you're going to make, but if the key person leaves, there goes 20%, 30% of your income, or maybe 100% if you're not careful. And you buy this practice and you don't put a non-compete clause. You know what could happen? How he could sell you the practice and open a practice next door and take all of his clients. So you paid for a shell. This case, I estimated that 20% of the cash flows in this restaurant came from this chef's name. That if he left, 20% of the cash flows would go with him. The case of Howie, I said he'd probably have a discount of about 30 or 35%. That's what typical key person discount is in medical and dental practices. And Howie was not happy. So he asked me a question, and you could probably answer this question. He said, can I do something to reduce this discount? You see how he's from? He made a lot of money last year, but the person buying the practice is unwilling to pay based on their income because they're worried without Howie around that a third of the clients could go away. So Derek, is there anything that I can do to reduce the key person discount if I'm the dentist?
You could refer or still be there, but not do the actual work.
Exactly, right? And in fact, in many medical and dental practices, when the practice gets sold, the old doctor or the old dentist will stay around for a year. He won't do a thing. He just hang around, and when a client comes in, he'll walk you over, he'll introduce you, schmooze, get you comfortable with whoever the new dentist and the new doctor is. That's what Howie did. He sold the practice and stayed on for a year. He didn't want to. He wanted to be in Florida, California, wherever he wanted to go. But he realized that if he did that, he'd give up too much value. That's a key person discount. It's not just doctors. It's not the dentists. You sell a plumbing practice. Key person discounts can be huge because your relationships are personal. They're not based on the business name. With public companies, we kind of avoided this issue, right? Assuming that in a public company, there is nobody that key. But is that true though? I mean, Can you imagine valuing Tesla with or without, with and without Elon Musk? I think you'd get very different valuations. I mean, much as you might pick on Musk's weaknesses, let's face it, net he's a plus for Tesla. And I think that's a problem. Do you see why? Because if you're a founder, you build a great company, but you build it to a point where you are the center of the company. Everything revolves around you. It's much riskier than a different company where the founder essentially finds a way to transition. To me, the essence of great founders, CEOs, is they make themselves dispensable. I mean, much as I dislike Microsoft, I have to admire the way Bill Gates essentially separated himself from Microsoft. Remember, Bill Gates left in the 1990s. He was a young man still. He left Steve Ballmer as the CEO, and he said, and the day he walked out of Microsoft, he said, don't expect to see my name attached to anything attached to Microsoft. I'm not going to second guess what they do. This is now Steve Ballmer's company. That takes a lot of, very few founders can do that. But if you look at Microsoft today, it reflects Bill Gates' decision to walk away and make the company stand on its feet. You probably know that Jeff Bezos has officially said that he's not actually going to be running Amazon now. And I think Amazon has been set up in such a way that it can live without Jeff Bezos. Tesla, unfortunately, Elon Musk has made it all about himself. And that is sometimes a double-edged sword because, let's do a little what if. Would you be surprised if tomorrow you woke up and you saw the lead news story being that Elon Musk has checked into rehab? It wouldn't surprise me in the least. I've been expecting this to happen for 10 years? And if he checks into rehab, what do you think is going to happen to Tesla's market cap the minute that news story comes out? That's terrifying. If you're a Tesla investor, that one person can affect your value so much. That is the key person effect. Any questions about key person effects? Now, as you're doing all of this, remember, it's just because you're valuing a private company doesn't mean you have to forget all your valuation fundamentals. And one of the fundamentals, if you want to grow, you got to reinvest. And how much do you have to reinvest? It depends on what kind of return on capital you think you can make in perpetuity. You thought returns on capital mattered only for public companies? Think again. If you have a 20% return on capital, in this case, I'm going to assume a 2% growth rate. Why? Because a restaurant is at capacity. This reinvestment then will be to redo the decor, keep the kitchen going. I'm not expanding the restaurant. And this is where Arm's point about synergies might come in. As a potential buyer, I might have different plans, right? I might plan to franchise this restaurant. Maybe this is a soul food restaurant, and I think I can franchise it in 10 towns. In which case, I'll reinvest more and grow faster. Everything we talked about in the context of public companies can come into play here as well. And the value that I'm going to get with those numbers that I've shown you so far. So there's the key person adjusted operating income, the cost of capital based on the total beta, and the reinvestment rate based on this very moderate growth rate. The value that I get for the restaurant is 1.45 million. Remember, I capitalized leases and treated as debt. If I subtract out the present value of lease debt, the value of equity that I get for the restaurant is 521,000. Now here, I'm going to go back to Tim's point. Tim, remember at the start, I used a 14.33% debt to equity ratio, the industry average.
Yeah.
Am I being internally, am I contradicting that? Because what am I saying the debt to equity ratio is for this company based on my assessed values? The debt is 928,000, my equity is 521,000. You divide the debt by the equity, that's like 180% debt to equity ratio. That is a contradiction in this valuation, right? And if that bothers me, is there a way I can fix it in my valuation? Clearly I was wrong using the 14.33% or even using what Rodrigo suggests, which is a price earnings ratio. I have an actual debt to equity of 180% based on my assessed value. Is there a way I can make my valuation internally consistent? But what if I took my debt to equity ratio that I've computed based on my assessed values, 180%, went back to step one where I did the beta and did a levered beta using this much higher debt to equity ratio and much higher debt to capital ratio? I'd get a different cost of capital, right? And then I revalue the firm at a different cost of capital. There's a problem here. There's a circularity. I need the cost of capital to get the value. I need the value to get the cost of capital. And here's how you can get around it. If you go into your calculation options in Excel, set the checkbox on iterations and make your debt and equity your assessed values rather than this industry average or a pricing based number. You can then get an internally consistent valuation of a private company where your assessments of the value of debt and equity become the weights you use on debt and equity to come up with a levered beta and a cost of capital. So in an Excel spreadsheet, what will happen is your debt and equity will be the numbers you get at the bottom of the valuation, but they'll be okay because you can coexist if you've set the iteration box. But if you don't set the iteration box and do this, your spreadsheet will go crazy. You get that circular reason, it's circular argument warnings, and you'll see all kinds of lines being drawn. But with private company valuations, I often do that. Rather than use an industry average or a pricing-based debt to equity ratio, I use my own assessed values for debt and equity as the weights that I would use to come up with the existing cost of capital. Any questions? So my value for the equity is 521,000. I did try the iteration box. You might be surprised by this. My equity value didn't shift that much. It dropped to about 510,000, but I'm going to leave it at 520,000. That's my value of equity in this business as a private business. There's one last stop I have to make. We talked about the cost of buyer's remorse. If you're the investment banker, you buy this restaurant because you're tired of investment banking, and then you realize 6 months later that this is far more work than you thought it was going to be, a much bigger headache. Selling or getting out of this business is much more difficult than in a public investment. That's why in private company valuations, you get what's called an illiquidity discount. Now, here's how it'll work. If you've ever seen private company appraisal value companies, they'll go through a DCF and they'll come up with the value. And after they've come up with the value, they'll knock off 25%. So why? It's an illiquidity discount. Now, I don't have a problem with the intuition as to why there should be a discount. The question is, why is it always 25%? Because it seems to be a fixed number. Because I'll state some general propositions and you tell me what you think. I would expect the discount to be smaller for healthy money-making companies than for money-losing trouble companies. Do you agree with that? So the discount should be smaller if you're healthy and money-making. Your discount should be smaller if the economy is doing well and you're not in a crisis than if you're in a crisis. Because in a crisis, you worry a lot more about how will I get my money out. So I'd expect the discount to be much larger in March of 2020 or November of 2008 when the market was in crisis than in a period when the market's doing well. And thirdly, the discount should actually depend on the potential buyer, right? If the potential buyer is really wealthy and doesn't care about whether they get their money back quickly, they care about the discount, illiquidity a lot less than somebody who needs to get the money back. So I'd expect the discount to vary across companies, across time, and across buyers. And now do you see why this is going to be the most difficult number to kind of generalize? Because it is really transaction specific. I need to know who your potential buyer is before I can tell you what the discount should be. So let's see how to estimate this discount. You're saying, where do people get this 25% that they seem to use as a routine discount? That's a question I asked 30 years ago, and I noticed this discount. There are two sets of studies they focus on. One is studies of what are called restricted stock. These are shares issued by publicly traded companies that come with restrictions on trading. In fact, if you buy these shares, you're not allowed to trade them for 1 year or 2 years after you buy the shares, depending upon the timing of your transaction. So these are publicly traded companies. They issue these shares called restricted shares. And if you buy one of these restricted shares, you're not allowed to trade them. You're saying, how does that help me come up with a discount? Because these companies are publicly traded, you can see the market price of regular shares and compare to the market price of the restricted shares. If people don't care at all about liquidity, the two should trade at the same price. But they do. So the restricted shares trade at a discount. You can estimate how much that discount is. The second set of studies look at IPOs and then look at the 3 months or 6 months before the IPO to see if shareholders in the private company are selling shares to each other. And if they do, at what price relative to the IPO price. The IPO is imminent. You know your shares are going to go public at 100. I would expect you to want to ask, a little close to 100, but because you want to get the money earlier and get liquid, you might have to settle for a discount. So you can actually observe how much that discount is. Almost everything that private company appraisers do comes from these two sets of studies. So I'm going to start with restricted stocks because those studies have been around longer. They go back to the 1970s. And in the 1970s, people looking at restricted stock issuances. And there are relatively few companies that have restricted stock. So these are not the restricted stock you see that employees have because those never get traded. These are actually restricted stock issued directly to investors. And I'll set up the background. Normally, if you're a publicly traded company and you want to make an equity issue, you got to go through the SEC, prospectus, filing process. It takes time, it takes effort, it takes money. But let's say you're in a hurry to raise capital. That already should give you a clue as the kind of companies that use restricted stock. They need capital, they need it today. They can't go through the SEC process. The SEC actually gives them a loophole, if you can call it that they can use. They can issue shares without a prospectus, without going through the SEC process. But the shares that are issued cannot be traded for 2 years after they're issued. Do you see why this is a great sample to observe liquidity? These are public companies. You can see the stock price is 10. Then you can see what price they get on these restricted stock issues. If they get only 8, that's a 20% discount, 10 versus 8. So the early restricted stock studies focused on the typical discount, found 30-35% discount between the market price and the restricted shares. In the 1980s, Bill Silber used to teach at Stern. He used to be a legend in the MBA program. He taught the foundations class. In the 1980s, he did a study, and he laughs about it still because it's a study that he did over a summer. It was a throwaway paper. It ended up being his most referenced paper of all time. And in the study, what he did was he looked at restricted stock issuances. There were about 80 companies. He observed there was a discount of about 30%, but then he noticed the discount was much lower for some companies and much higher for others. It was only 15% for some, 45% for others. And then he asked, why are they different? Why are the discounts smaller for some companies and larger for others? And he noticed that companies which were bigger with more revenues had smaller discounts than companies that were smaller. He noticed that money-making companies had smaller discounts than money-losing companies. He found that the larger the restricted stock issue as a block, number of shares issued, the bigger the discount than when they were small. So what he did was he took that sample and he ran a regression of the discount that he observed against the level of revenues, whether the company was making money or losing money, how big the block was, and if the person on the other side was a customer or a supplier, were he worried about no other potential payoffs, right? Customer pay a higher price for the restricted stock and get a better price on the product. And he ran a regression across all restricted stocks. He's saying, how is this going to help me? He actually quantified how much of an effect higher revenues would have on your discount, how much of an effect it had when you made money as opposed to losing money. This is how different your discount should be. So in the 1990s, I actually took Bill's study and I said, okay, your typical discount is 25% by looking at all restricted stock companies. Let me look at what the discount would be if you're a money-making versus a money-losing company. If you're a small company as opposed to a big company, and I'm using revenues to measure that. So let's take an example. If you're a private company with $1 billion in revenues, you're a big private company, and you're a money-making company, based on that regression, your discount should be only 15%. The illiquidity discount, smaller discount. If at the other end, you were a very small company, revenues of 5 million, it's losing money, your discount should be 35%. So I said, at the very least, even if you trust these restricted stock studies, which I wouldn't, but if you did, you should be varying your discount across companies based on their size and based on whether they're making or losing money. But it's still built on those restricted stock studies. And they are, I think, flawed, and we'll talk about why in a minute. But to the degree that you're using these studies, at least differentiate across companies. And then came the IPO studies. And the IPO studies claimed to find discounts that were so mind-bogglingly large that I don't believe them. And let me explain. Let's assume you're a shareholder, you were a shareholder in Coinbase, in the private Coinbase. And you knew 3 months ago that this IPO was coming. You were leading up to the IPO. And let's say you expected the IPO to deliver a market cap of roughly 100 billion. People were talking about that's what the market cap turned out to be, 100 billion. Well, it works out, let's say $100 per share. But you're in a hurry. You don't want to wait for the IPO. You want to sell your shares now. This is 2 months before the IPO. Now, clearly, you're not going to get $100. That's the expected price. You have to accept a discount. How much of a discount? We can observe that in the transaction. And that's what these studies do. They look to see how much of a discount people accept for selling their shares before the IPO. And they claim that the discount is as high as 40 to 50%. This sounds unbelievable to me. If you think you can make $100 2 months from now, are you really selling your shares for $50 just because you don't have you want the liquidity for 2 months? So I started asking questions about these studies because the numbers just didn't make sense. They seemed too big. And fundamentally, my problem with both the restricted stock studies and the IPO studies is a sampling problem. Let me explain. I told you that if you look at companies that use restricted stock, there are companies that are in a hurry to raise capital. They don't have very many options. They can't borrow money. They tend to be troubled companies, small companies. So when I look at a restricted stock sample, I'm not just looking at a random sample of 70 companies that issued restricted stock. I'm looking at a subsample of small troubled companies. That's a sampling problem. Same thing with IPOs. When you see a lot of owners trying to cash out before an IPO, I'll wager that very few people at Coinbase were trying to sell their shares before the IPO. You know why? Because it looked like it was going to go well. The kinds of IPOs where you see a lot of pre-IPO transactions, the ones where you're concerned about whether the IPO will go through, another sampling problem. I mean, most of these fights about the liquidity discount have happened in court, because here's where it usually shows up. In tax court, often you value a business because you have to pay taxes on that value. So the owner of a business hires an appraiser to estimate the value and tries to come up with as big a discount to knock the value down. The IRS, of course, wants you to pay a higher number. But for the longest time, the IRS was a penny pincher when it came to this. It hired these really cheap experts. But 20 years ago, the IRS finally decided that they had to contest these restricted stock and IPO discounts because basically they were eating up 40% of the value. They actually hired a somebody who knew their statistics for the first time. They were willing to pay the price. And that person actually went through the restricted stock studies and IPO studies. And here's what he concluded. The typical discount in a restricted stock study is 30%, but only 10% of that is for illiquidity. The remaining 20% is because you're this strange, skewed sample. It's long overdue. A lot of stuff that happens in private company valuation is based on looking at these very small samples of illiquid companies and extrapolating from there. So I don't trust these restricted stock studies. I don't trust these IPO studies, which left me in a bad position 20 years ago. I said, what are you going to do instead? So I came up with a suggestion. You tell me what you think about this. This notion that private companies are illiquid and public companies are liquid strikes me as incorrect. Liquidity is a continuum. You know what I mean by that? If you look at an Apple or a Facebook, incredibly liquid stock, right? But if you look at a small, lightly traded NASDAQ company or a small Malaysian company that's publicly traded, it's a very different game. So rather than think of this as a 0-1, what if you thought of it as a continuum? Trust me, I'm going somewhere with this. So here's what I did 20 years ago. I collected the bid-ask spread. I told you that's measurable liquidity in a public company for every publicly traded stock. So now think of my sample size. It's not just 60 companies making restricted stock issues or 30 IPOs. It's every publicly traded company. I looked at the bid-ask spread as a percentage of the stock price. Think of that as the discount on that public company. And then I looked to see what variables best explain why that spread varies across publicly traded companies. And I track what Bill Silber did in his restricted stock study. I looked at revenues and I found that companies with bigger revenues had much smaller spreads, more liquidity. Companies that made money had much smaller spreads, were more liquid. Companies which had a lot of cash had much smaller spreads that were more liquid. All follow intuition. And I also found, not surprisingly, the more trading volume there was in the stock, the smaller the spread was. I had a regression equation that related the bid-ask spread for a public company to all these fundamentals. You think, how are we going to use that to get the liquidity discount for a private company? Look at that restaurant. I plugged in the revenues for the restaurant, the fact that it was making money, how much cash it had, and the fact that it never traded. In this regression, just put in zero as trading. I got a predicted discount based on the bid-ask spread regression of 12.88%. So here's what I have. I could go with what private company appraisers use, which is what I call the bludgeon approach, just knock 25% off. Why? Because everybody does it. I can adjust that discount for the fact that this is a company with small revenues making money, gives me a slightly larger discount, or I can treat it as part of the continuum of public companies and come up with a 12.88% discount. That discount comes right off my 521,000 that I estimated as the equity value for my DCF model. That's step 6. I'm not going to argue is a perfect answer, but basically what you're saying is with a private company, I'm knocking off some of that value for lack of liquidity. And the bid-ask spread is as good as any an approach to estimate what that discount should be. Any questions about illiquidity? Go ahead, Sriram.
So with your bid-ask spread regression, because you're extrapolating from public companies and you're using zero volume, which no, I don't think any public company has zero volume.
The public companies are very, if you look at across 7,500 public companies, so remember you go past the NYSE, you go past the NASDAQ, you're coming into stocks, so you might have one trade every month.
Yeah.
So you're getting very close to zero. You're right, I am crossing a line by saying, you know what, never happens. But maybe I can look at how many times a private company's been sold in the last 5 years. It might not be zero. But you're right, I am crossing the continuum. But keep going. So
wouldn't that represent like a good, I guess, lower bound of your
it could.
of your
So maybe the
discount?
12.88% is a lower bound and should be a number slightly higher than that. But it depends on what my sample looks like. My sample is enough publicly traded companies with close to zero trading volume. I'm going to be able to use this regression much more. That's why I can't use the S&P 500 and run the regression. It's got to be across all US companies. There's a reason I haven't upgraded that regression in 20 years or updated it. It was a lot of work. By the time, it took me like 2 weeks because I had to pull the data on bid-ask spreads from one database and the rest of the data from a different one. I had to merge these huge data sets. But I tried very hard to bring in as many of those small, very lightly traded stocks precisely for the reason that you mentioned, which is I was crossing this bound of putting in a zero trading volume.
Okay, thank you.
Yeah. One final thing and we'll end for the day. Let's do a second scenario, and this is going to be far simpler. Let's suppose I'm selling a private company to a public company. Remember now, the investors in the public company are diversified. So no longer I have to use a total beta. I can go back to a market beta because the investors in the company can get rid of the firm-specific risk. Second, once a private business becomes part of a public company, liquidity is not an issue anymore because even though you can't trade the restaurant, you can trade in the shares of the public company. So here's what I did. I took my cost of capital and replaced the total beta with the market beta. Went back to a market beta saying if the buyer is a public company and diversified, I can use a market beta. Take a look at what it does to my cost of capital. It goes from 13.25% to 8.76%. I'm leaving everything else unchanged. I'm just using a market beta instead of a total beta. And then I revalued the company with that lower cost of capital and no illiquidity discount. So 2 big changes. One is the total beta gets replaced with the market beta, lower cost of capital. The second is the liquidity discount disappears. The value that I get for this company is 1.48 million. That's more than 3 times what I got as a private to private transaction. So if you own this restaurant, you're the French chef, you're desperately trying to get a publicly traded restaurant company interested in buying you, right? Let's say you do. I've given you 2 values for the company. One is the 454,000 you get in a private transaction. The second is the 1.484 million that you get from a public company. Remember, you're sitting across the table from me. I'm the CFO of the publicly traded company. You're the restaurant owner. What price are you going to start your negotiation at? What are you going to ask me right off the top? What's your starting point? If you're trying to sell this restaurant to the owner, I'm the CFO of a publicly traded company. Where do you want to start your negotiation as the owner? What are you going to ask for?
Would I basically ask like how essential the owner is to the business?
You want to act like that you're absolutely essential to me. So you know what you're going to start off with? He said, you're going to start with 1.484 million. You know what I'm going to say? No, I'm not paying you 1.484 million. You're a private business, you're illiquid, and so I'm going to throw everything, even though it doesn't apply to me, I'm going to throw everything at you. You know what we're probably going to end up at? We're going to probably end up at 500 or 600,000, higher than the 454,000, but definitely not 1.4 because the bargaining power is with me. I'm the one bringing the diversified investors in the game. I'm going to demand a much bigger share. You see, the only way you can fight that is we've got 2 publicly traded companies interested in you, bidding against each other. Then you have a shot of getting the 1,484 million or 1.484 million. That's why at the start of this class, and I said, if you have a private business you're trying to sell, the most critical part of this process is trying to expand the buyer pool. So it's not just another individual. It's not just one public company. It's 2 or 3 public companies, because then you can get them bidding against each other. And you get the maximum price you can. Now, on the synergies, don't get too greedy, because if you try to reach for the synergies, then I'm going to push back saying, who's the one delivering the synergies here? It's not you by yourself, it's me. And unless, again, you are the unique resource, you own a restaurant that nobody else has anything like, odds are that I'm going to be able to keep the synergies. Later in this class, in a couple of weeks, we're going to talk about acquisition valuation. M&As are where value goes to die. Companies waste money in acquisitions. There's one area, though, where there is value created in acquisitions, when public companies buy private businesses. They create roll-ups, and often the reason for that is that difference in value that you saw between private company value and the value of the same company to a public investor. So I'm going to let you go, and I will see you in a week. So try, if you're way behind on you shouldn't be, right? If you got your DCF done, I know many of you are working on your pricing, try to get it done, get it out of the way so that you've got you have the rest of the semester to prepare for your other classes, get ready for the 3rd quiz and the final exam. But I will see you in a week.
Thank you.
Thanks,
Take care.
Professor.
Professor.
Thank you.
Professor, just a quick question. For the
Right.
final exam, is it similar to the quizzes?
You mean similar as in multiple choice? And yeah,
Yeah, like it's the
choice
structure.
calculated questions, but it'll be more questions, because I don't want to make the questions longer and more involved, because you don't want to leave 5 points out of 30 on one question that you got wrong. So my guess will be about 10 questions, which would be about 3 points a piece, so that if you mess up, it's only on 1 or 2 of the questions. So it won't be the end of the game, but it will be similar. Yeah.
Okay, and like I guess similar questions as we've already seen in previous quizzes.
Well, obviously the topics will be different. Yeah, it'll be similar questions. In terms of difficulty, it'll be very similar to the quizzes.
Okay, got it. Thank you.
Hi, Madhur, go ahead.
Hi, Professor. I was just wondering, is the date on Albert the actual date for a final exam? Because I know sometimes it changes.
I think what's the date you see on?
I think it's the 12th.
I think, yeah, it is the right day, because they'd originally scheduled it for a later day, but they moved it to the 12th, which means the good news is you're going to be done early. The bad news is you're one day after your last class to get ready for the finals, which means if you're working on your project till the very last day, you don't have much time to prepare for the final. That's another reason why you might want to get the project done as soon as you can.
Yeah, sounds good. Thank you, Professor.
Okay. Hi, Olivia. How are you?